Good afternoon, everyone. We'll be starting the webinar here in just a few moments as additional folks continue to dial in. Okay, well, the numbers keep ticking up, so why don't we give some of the folks that are dialing in here just another, say, 30 seconds or so to get situated, and then we'll get underway with today's webinar. Okay, so I'm showing 1:31 here on the East Coast. Welcome to everyone, and a happy 2023 from us to you. We really appreciate your time today and the ability to have hopefully a conversation and chat with you a little bit about what's going on in the property and casualty specialty insurance marketplace. I would encourage anyone that has questions to submit those questions in the box to the right-hand side. We will go through those questions, time permitting, toward the end of the broadcast today, and I'll do my best to pull the questions together if any of them overlap or what have you. So again, thank you, and let's get underway. I'd like to introduce myself. My name is Paul Smith. I'm a Corporate Senior Vice President at the H.W. Kaufman Group, and it's my pleasure today to basically have a conversation with three of my colleagues regarding what's a very, very interesting marketplace right now as we start 2023. So let me introduce my colleagues, and I'm going to start with Bill Gatewood. Bill's raising his cup to the audience here. Bill is Corporate Senior Vice President and Head of Burns and Wilcox Personal Lines. Bill is based out of our corporate headquarters in Farmington Hills, Michigan. Welcome, Bill. Next on the list here, if you could raise your hand, Barry Whitten, Managing Director, Burns and Wilcox Brokerage, and a property broker himself. Barry is based out of our Atlanta, Georgia office. Welcome to the broadcast, Barry. And last but not least, my fellow namesake, Adrian Smith, brothers by another mother, as I like to say all the time when I speak with Adrian. Adrian, raise your hand. Managing Director of Burns and Wilcox Brokerage and Casualty Broker. Adrian is based out of our Chicago, Illinois office. Welcome, Adrian. So let's get underway, folks. We have a large audience today. Let's just jump right into some questions here. Bill, I'm going to start with you. Can you please provide our audience with an overview of the E&S personal lines marketplace, including typical things that we often talk about: rate, capacity, terms and conditions, and perhaps very important for this call, January 1st reinsurance outcomes, and what the participants in today's webinar should anticipate for 2023?
Yeah, thank you, Paul, and Happy New Year, everybody. I think 2023 is going to be a bit of a repeat of 2022. A lot of the challenges that face the industry last year just kind of rolled over with the calendar. They didn't disappear when the ball dropped, unfortunately. So the industry in personal lines is still dealing with profitability on the property side. They just haven't been able to consistently make money. There's still a lot of concern on weather and weather-related losses, and how do we manage that, and how do we properly write business in these cat-exposed parts of the country. And then, as you mentioned, rising reinsurance rates and the reduction in reinsurance capacity for carriers that are writing U.S. homeowners along the coast and then fire-exposed parts of the country. So we're certainly going to have to deal with those things in 2023. So what I have seen thus far in the fourth quarter of last year, and in the conversations we've had about this year, I think we're going to continue to see property rates increase all over the country. This is not just a Florida problem or a California problem. We'll see rates going up all over the country. They'll go up at different levels. Obviously, you'd expect some of the higher hazard states to see larger increases, but that'll be something we'll see all over the place. We'll continue to see some constrained capacity. There's less personal residential property capacity in the market than there was last year for a variety of reasons. Some people have made decisions to pull out. We've had some carriers that have gone insolvent. So there's just less capacity than there was overall. We're going to see increased deductibles. I think we've already started to see wind deductibles going up. I think the personal lines space is a little bit behind commercial in that regard. We've seen commercial wind deductibles go up a little faster and a little higher. And I think personal lines, this will be the year that we see that, but also on the AOP side, because not everything is wind driven. There's still a lot of water losses and fire losses. And I think we'll see some more deductible changes there as well. Another interesting phenomenon that's going to happen is the use of the E&S market. I know we're going to talk a lot about that on this call, but a lot of carriers are moving their business to the surplus line side intentionally, and we can talk about why that is later. And then it'll be interesting to see how the governmental programs continue to play a role in everything that's going on in the insurance market, particularly in some key states. So I know none of that sounds great, but I'll wrap it up with this, Paul. There will be capacity in the marketplace. It's just going to come at a higher price. And I think that it's going to be much more attracted to quality business and that I think is to be expected, but there will be capacity available, just maybe not at the rates and terms that we've been used to.
Thanks, Bill. Appreciate that overview. And hey, you're right. I do have some questions a little bit later on in our discussion, talking about why the E&S marketplace is so opportunistic right now. And hopefully many of our agents that are dialed in today will hang around and hear some additional thoughts. Okay, so that's a great overview on the personal line space there. Hey, Barry, same question really for you, focusing on E&S commercial property on brokerage accounts and how the dynamics surrounding property loss trends have changed in recent years, okay, relative to, say, named storms. And again, how's that going to impact 2023 with also a look at some of the reinsurance deals that are either just completed or being completed as we speak today?
Yeah, thanks, Paul. Well, as Bill said, obviously we're in the continuation of a 3-year plus kind of hard market for property. And I think in order to talk about the marketplace for 23, we need to go back and look and see what's happened the past few years. So interesting enough, 30 years ago, when Hurricane Andrew hit South Florida, it was about a $20 billion event. At that time, unprecedented, never heard of before, and most people thought it wouldn't be heard of again. However, since that time, we've had 7 hurricanes in the past 6 years that are over $20 billion. That's just in the past 6 years. In fact, according to the Insurance Information Institute, 5 of the top 10 costliest hurricanes on record have happened during that same period, again, in the last 6 years. So one of the interesting things that I noted was that in the last 50 years, we've only had 9 Category 5 or Category 4 storms hit the U.S. 6 of those 9 have happened in the same time frame. So obviously, the last 6 years, 6 to 7 years, have not been good for property insurers, and that's just the named wind issues. Obviously, when carriers are looking at treaty reinsurers, they've got lots of other issues. We've got other kind of cat losses that occur. Just think about a couple of years ago in 2015, the freeze in Houston. That was $15 billion. Just 2 or 3 weeks ago, the freeze is another 5 or 6 billion. So all that rolls into cat losses for the reinsurers. So all of those things are basically in play for every market when they're going into their 1/1 treaty renewals. So they were having to deal with this issue, and that doesn't even count tornadoes, convective storm, wildfires. So it really was a very frustrating time for most of the markets for the 1/1 treaty renewals. And so at the end of the day, they had a tough time with their prices going up, as Bill said, with their capacity reduction, with basically some of their retentions going up. But what does that mean to you as an agent for 2023 and your clients? It basically means that every property insurance carrier had significant price increases. And actually, Howden Group out of London just published a report that said the average increases were 37% for their treaties for January 1st. That's basically clean portfolios. If you've had a portfolio that's had lots of damage, those are looking at 50, 100, 150% increases. So all that does trickle down. So, as an agent, if you're asked what to expect for 2023, my answer would be for 2023, you need to expect continuation of the increase in rates. You need to expect increased underwriting discipline and demand for valuations, and to understand that most carriers will be reducing their capacity offered.
Thanks, Barry. Appreciate that. Interesting how we're going to, kind of work through all of these things here. I do have some questions later on how we're going to assist our clients and our agents in getting to, make sure that we have a, the ability to find capacity for them and help them through these difficult times. Adrian, flipping over to you. Hey, same question to a large degree. Hopefully you're taking a deep breath, and glad you're on the casualty side based on what Bill and Barry just said. But so focusing on the E&S commercial casualty brokerage space, what are the particular classes and lines of business that are generating the greatest concern within the casualty sector? I have a couple that come to mind, being a casualty guy myself, but I'll leave it to you. And what to expect in 2023 for our clients that are listening in today.
Thanks, Paul. Well, Happy New Year, everybody. And I think the last one of these presentations I did was the middle of the pandemic, so it's kind of exciting to be back in the office and seeing our underwriters again in the city in Chicago. Well, really, I've got some much better news on the casualty side. I mean, the casualty marketplace has really done its job the last 2 years. We've had, just umbrella alone, perhaps 25 new entrants, whether these are insurance carriers, MGUs, delegated authority. Often these are underwriting facilities that have opened up a new umbrella unit, utilizing a hybrid fronting mechanism in the reinsurance marketplace. So the E&S market has really done its job. We've got a whole bunch of new capacity in the umbrella space, also in the primary space. And then when you take to certain areas like long haul trucking, we've got several new entrants there, typically managing the limits at 2 million. So the market, the casualty markets responded, particularly on umbrella, by focusing on the lead umbrella, looking at perhaps a short limit, a 5 million limit, so managing the limit. And then what we're starting to see now is excess of 10 million, you're seeing carriers putting up 10 mil, potentially 15 million. So it's a much better marketplace than it was a year ago. But I think just looking around at the different industry classes, whether it be professional liability, property, they all seem to take the term in the marketplace, as a raging hard market for, D&O, public company D&O. So we've stabilized in casualty, but also the court system has been closed for the last 18 months during COVID. So I expect that to accelerate over the next year. So we're going to still see rate increases, but it's a much more orderly renewal season in the reinsurance world in London. So that's really the message that we have. But within casualty, there's often these micro classes of business which are super hard. A good example of this, habitational, real estate type business, managing the assault and battery exclusion. So terms have become a lot tougher over the last year for assault and battery. So now, expect a sublimit, potentially an exclusion. So that's become very difficult. Where different venues like Florida's become exceptionally difficult, due to the Champlain Towers collapse. We also, in the crane space recently, we had a carrier exit, so that's created a disruption. There's, very few markets will quote lead umbrellas on crane business. So it depends where you're in the marketplace. Public entity business is very difficult with, sexual abuse, molestation, police professional, heavy fleet business. So we're still in a challenging marketplace for casualty, but we just have a whole bunch more capacity in the marketplace, which has stabilized things. So I would say this year, we are going to see rate increases, but there are some more medium hazard classes where we've seen standard markets coming in. We had one recently for 1/1, an excess layer where they came with a 30% reduction. So reductions are possible, but if they're really difficult accounts, which typically is what we see in our world, I would be expecting rate increases still, but perhaps not 20%, maybe more in the single digits.
Yeah, hey, thanks, Adrian. Appreciate that. So it really comes down to the class of business. Also comes down, I think, to a large degree, what's the loss history on the account, right? What's their, their actual history, and then, you bring up a good point with some of the courts starting to open up again, and was there maybe a brief hiatus, if you will, of some claim activity because of that and pandemic. So we will monitor that topic very closely and look forward to follow-up discussions as the year progresses. So appreciate all of that. I'm going to change direction a little bit now. I think we've kind of created the foundation, if you will, for a discussion that I think is hopefully a little bit different, right? We've set the tone with respect to high level what we think 23 is going to look like. Some of the reinsurance deals aren't quite done yet, but still being worked through, but we'll be there in short order. So in that spirit of changing direction, Bill, I'm going to go back to you, and I'd like you to share with our audience some commentary on what I'm going to say are the opportunities that exist within the E&S marketplace, allowing us kind of greater latitude to assist clients with differentiating their accounts through, kind of many different means, and what we can kind of do to apply creativity, my word, that can kind of help them get through these difficult times.
Yeah, thank you. I think if we look at what the purpose of the surplus lines market is a great place to start. The E&S market it's a safety net, it's a release valve for the admitted markets, and that's really important because in the E&S space, we have the ability to put together creative solutions through rate and form, right? We're not tied down to, admitted, approved rates and forms, so we can get very creative there when we need to. And then that allows us to provide a more customized solution for our agents' clients and to get adequate rate for risk, which is really important because right now, what I hear from carriers on the admitted side is they are having a difficult time getting rate increases through various departments of insurance. It's taken a very long time to get them approved, and they can't always get the amount of rate that they're filing for. And so that, when you have an unprofitable industry that can't get the rate that it needs when it needs it, it just exacerbates the unprofitability issue. So we're seeing a lot of admitted companies flipping over and using E&S paper because they can get the rate and they can get the forms. And I think sometimes agents will view that as a negative, but really the alternative is those carriers call up and send a letter out and say, we've shut off business. And so this is a way for the insurance market to continue to progress, right? It's a way for us to provide solutions for our retail agents and their clients. So the safety net's working. And I think some other opportunities that are available in the E&S market, and I'm kind of passionate about this. I have a lot of agent friends around the country who are a little reluctant to use the E&S market. They've got a bias against it, and so I just want to hit on a few of the opportunities that come with the E&S market. And the first one is expertise. Most of the business that comes into the E&S market comes here because it's a challenge. And so you're working with people that have a great amount of knowledge and expertise in placing those challenging risks. In my space, whether it's a very high value home that's right on the coast, it's a high profile individual, it's somebody that's had some problems with their insurance in years past, whatever it is, you're going to deal with an expert that knows how to solve that problem and knows how to navigate the market to find that solution. Another opportunity that I think is very important these days is that the carriers in the surplus line space are very financially secure. And I think that's an area where agents sometimes believe that surplus lines means carriers that don't have a lot of financial strength and they just started yesterday, and that's just not the case. You've got a great deal of financial strength in the surplus line space, and all you have to do is just look at the number of financial impairments on the admitted side versus the E&S side in recent years, and it's not even a contest, right? We've had no financial impairments on the E&S side and several on the admitted side. And we have a lot of agents coming to us now with a book of business that they've had with a B-rated carrier or another carrier that was undercapitalized and has gone insolvent, looking for a home for a gigantic book of business. And you can't ever retain that entire book. You can't move the whole thing. It's a lot of work on the staff. And so nobody should be hesitant about coming into the E&S market because of financial strength. It's there. and all the things that go along with a highly rated company, right? We've got great claim service in the E&S space. You don't give up anything there. You don't give up anything on the coverage side. There's plenty of coverages available. In fact, sometimes you can get broader coverages and more unique coverages and manuscript coverages than you can on the admitted side. And so I would just say, if agents are avoiding the E&S market, they're missing out on opportunities for their clients, but they're also missing out on revenue for their agency, because the E&S market continues to grow. It's going to continue to grow in 2023, and you're going to miss out on a significant part of the industry.
Yeah, hey, absolutely, Bill. So, hey, a couple of things come to mind with your answer. I read recently that, last year we were approaching 100 billion in premium in the E&S marketplace. I'm sure those calculations will find their way through in the next couple of weeks. And so it's a substantial part of the overall marketplace, no question. Number two, yeah, that's the only thing we deal with, certainly at Burns & Wilcox, are insurers that are highly regarded and financially strong. We have a committee that reviews all of our carrier partners very, very carefully. We just tend to not always talk about that. So I'm glad that you brought it up. Hey, something else also that came up, and I'm a bit of a junkie reading kind of articles and things, but on January 3rd, a report came out from Howden and their head of analytics that said, and I'm quoting here, the sector, meaning the overall reinsurance sector, is experiencing its most acute cyclical price increase since 2001 to 2006 period, if not before. So if that really puts things into perspective, right? So a large broker, if you will, that's in the reinsurance marketplace just yesterday or the day before said this is the most acute cyclical reinsurance term since 2000 and early 2000s. So call it 20 years, if not earlier. So really interesting stuff. Thanks for that, Bill. And I think it's important that our participants today see all of that. Hey, would be remiss if I didn't ask both Barry and Adrian to chime in a little bit and talk about that same topic with respect to commercial insurance on the property side and the casualty side. Barry?
I'll just first, if that's okay. And Bill gave a good summary of why the E&S space is there. In reality, that's exactly why it's created. It is a distribution network that some of the admitted carriers have an E&S side. It was built just for this type of market. And if you went back and looked for the last 30 years, the growth in the E&S space is because of some of those things that Bill outlined: the flexibility, the ability to put forms together. Admitted carriers don't want and they're not able to write a lot of the risks that we see on a daily basis. It doesn't fit them for lots of different reasons, whether it's a catastrophic exposure, a certain geographic exposure for wildfire, occupancy. So that's exactly why we do what we do. Several of us in our past probably have worked on the admitted side, but have been doing this for 30 years on the E&S side while we want to grow. The good part is, as Bill mentioned, we typically can find some sort of terms to put on almost anything. As they say, almost everything is insurable. They may not be the terms you want, may not be the price you want, but you typically can find some sort of an insurable, bondable product to put on the table. And that's kind of what we do. From a property perspective, we have 40 or 50 markets we deal with daily, and that's all we do. So we don't play on the admitted side at all. We know they have their limitations of what they can do. So then when it gets into that tough categories, that's when we get involved.
Thanks, Barry. Appreciate that. Adrian?
Yeah, very much the same on the casualty side. I started my career, and I think the E&S industry was about 10 billion. It's, or maybe actually less than that, and it's grown now to 100 billion. Largest wholesaler back then was $1 billion of premium. Today, including some benefits as well, we've got $30 billion juggernaut wholesalers out there with the big three. So very much today you're coming to a wholesaler, for really two things: market access, but also industry specialization. And it's really the specialization that I think the wholesale world has developed tremendously, over the last 10 years. So the world has changed. But, definitely, as I said before, the casualty world has done a great job of developing new capacity over the last 2 years. But I think we all have to be careful about, the loss costs prior to 2019. They may not be funded adequately. So we could well be in another wave of firming of prices. So I think incumbents really want to manage the pricing on renewals, but there are new carriers out there, so it is potential to see rate reductions in some more standard type business. But typically we're seeing rate increases, and I would expect that to continue this year. We're still seeing, you know, an influx of business into the E&S world as well. And then we do have those very difficult classes of business, so, you know, such as security guards has become very difficult as a result of the mass shooting situations. So I think today we're in a very strong place within the wholesale community, and it really comes down to talent. Is over the last several years, you know, one of our biggest challenges is to bring in newer people from a retail background or insurance carriers, train and develop them. One of the biggest challenges I'm seeing today is our insurance company partners, our E&S carriers, they can't find underwriters. So, you know, typically a new facility will set up and write 50 million of business within its first year, maybe 100, but it's can they find the underwriters? So our limitation right now is really the underwriting talent with our carriers.
Yeah. Hey, great segue and unrehearsed for our audience, by the way. I use the term bandwidth all the time. You guys hear me talk about that, right? And that we only have so much bandwidth. Our carrier partners only have so much bandwidth. And that creates a responsibility on behalf of us to work with our retail agents to make sure that we have quality submissions, that they're thorough submissions. I'm sitting in a branch office today, and I overheard a conversation earlier where one of the associates was talking about he had an incomplete submission. He had to call the retailer back and say, I just don't have time. You need to tell me like what year the building was built and basic COPE information. So the question really here is, what advice do each of you have to primarily the audience today is our retail clients? What advice do you have to them to assist us in getting the best possible deal for them? And I'm going to ask each one of you to talk about it. So Barry, why don't you start off with that question?
Sure, and some of this is a continuation, you know, of messaging we've had in the past, because it has been a difficult market. But the biggest thing for 2023 is you've got to be proactive in getting in front of your clients. 90 days and more, you know, a lot of times the renewals and the discussions are held 30 days from the effective date. That's just not enough time in the marketplace today for what you just mentioned. Underwriters are going to look at a submission, and if it's not complete, they're going to put it aside and work on one that is. So a lot of this has to do with educating your client, letting them know what the marketplace is about, and they've got to make some difficult decisions. They've got to decide, you know, what limit they need that's being required by lenders versus what they can afford. You know, they got to look at potential retention changes and deductible increases. So all of those things take time to digest and come up with decisions. And we being part of that marketing arm, we need to understand what is the most important for your client. And one other thing on the property is, and it's going to be on everybody's plate, is, you know, doing an in-depth review of the valuations. Sure. It's on every treaty renewals contract. It's in every underwriter's mind. They're going to have to look at the valuations, and you need to understand we have to defend what those valuations are. Whether if you can get a third-party appraisal or have someone help you concrete what those valuations are, that's good, but it's got to be more than just a gut feel or I built the building 20 years ago and I've indexed it. With inflation and the high rising and quick rising of cost, that's a big issue. Last thing, remember the rate increases we've talked about. That's just one part of the formula. Premiums as a whole is that rate increase times that higher value is going to create significant exponential increases in premium for renewals.
Sure, understood. Yeah, we haven't even touched on it, and I know we have in previous quarters about the insured to value discussion. Certainly alive and well, and it's really incumbent upon us to make sure that we have it right. Carriers will be asking that question. Adrian, over to you. Any advice, hints, tips to our clients that are on the call today? I think you're on mute, Adrian. There we go.
Sorry about that. Obviously, quality and submissions are important. Getting ahead, managing client expectations is probably the most important thing. You can normally recognize an account when it's going to be a really difficult renewal. I mean, a lot of the accounts we're still seeing, they've got multi-million-dollar losses. They're distressed. You know, the more standard type stuff. Yeah, you're going to get rate increases, but they're not as challenging. There is capacity out there. But when you get into a lead umbrella account, say you've got a whole bunch of losses out there, it becomes very challenging. You may only have 3 to 5 underwriters want to consider the account. 5 excess of 5 layer, you may have several, 10 underwriters. So it just depends on the account. But what we try and do is managing attachment points on a primary basis. I go back to the early phase of my career, $1 million primary auto. That's what it was then. What happened to medical cost inflation for the last 25, 30 years? Not quite sure how $1 million primary auto limit captures things these days. So whenever you can get a 2 million primary auto and get a 244 aggregate on the GL, super helpful. One of the big trends we've seen over the last several years has been middle market captives, renter captives, different approaches. Back in the day, a captive was this huge $20 billion insured captive. Now it's these middle market captives. So if you have an account with a large workers' comp exposure, heavy fleet, captive approach makes sense. These captives can offer a 244 and also 2 million primary auto. Very cost-effective premium, way cheaper than the E&S marketplace. So that whenever you can do that, that's a great approach. But even some of the standard markets can come in and offer a 244. We had an account recently where we had a very challenging situation, and the standard market came back in for no additional premium on a couple $100 million contract that gave a 244, which saved us a tremendous amount on the umbrella. Don't know how our retail client did it, but their partners, you have to develop a strategy. So they made an accommodation at a high level, but it helped us tremendously on a challenging placement. Also, auto buffer markets, they can help. Typically over a couple of 100 units, it works out best. But I really think going in with a strategy, 5 years of loss runs, probably not enough these days. Carriers are asking for 7 years, but if you can get 10 years, that's even better. Historical information, really just managing expectations of the client is the most important thing.
Anything left for you, Bill, with respect to hints and tips? I think you're on mute now as well, sir.
Sorry about that. Yeah, I said surprisingly, they did a really good job. I won't repeat some of the things they said because it applies in the personal lines realm as well. But last month I was in New Orleans and had an opportunity to talk to a lot of agents down there who are going through a market transition like they haven't seen since Katrina. And one of the things that all the agents were talking about is the need to educate people on insurance. And they all talked about needing to sit down with their homeowners and their personalized clients and tell them what's going on in the insurance market, why premiums are going up, what they can do to help manage those premiums. And so we've got to communicate with our customer. I have yet to meet a person who enjoys buying insurance. And so we can help them through this process by explaining what's going on in the marketplace. And so I know it's important on the commercial side, but I think it's really important on the personal line side as well, because it's just not a product people like to buy. Another thing I'll hit on that I think is unique to the personal line space right now for our agents or brokers is that I think they need to be open to different solutions than we've had in the past. I think personal lines is kind of evolved to a point where you can get your property coverage, your contents coverage, your liability coverage, your scheduled property coverage all on one policy. And right now, with some of the TIV constraints we have, we're breaking those up into multiple policies, or we're writing X-wind policies, or we're writing wind-only policies, right, to help solve solutions. So I think being open to all of the solutions that are available in the marketplace and realizing that it might look different than it did before. You might be selling 2 policies or 3 policies to that same homeowner customer, but in the end, you're going to get them the coverage that they need. Right. And so that part I think is changing. And finally, I would say find a partner. Right. I know retail agents are great at selecting the carriers that they work with. In the E&S space, it's got to be the same way. I've instructed our practice that if we receive a submission that we know a retail agent has sent to 5 other wholesalers, we're just going to politely decline it and move on to the next one. Because we've talked about the amount of time and resource that we have, and that sort of transactional mentality just doesn't work in a hard market like we're in today. So find a partner that you trust, that you know is going to do the best job for you that they can, and work with that partner, because that's where we're spending our time. We're working with the retail agents who are partnered with us, and we're putting all of our time and effort into them and their clients. And so that shotgun approach just won't work right now.
Yeah, hey, well said. I certainly couldn't have said it any better. I've been through some hard markets. You guys have to a degree as well, but many folks haven't. So really, really great advice. Just summing it up in my mind, I wrote down some notes here, right? You want a timely submission, Barry's point, right? Let's try to get in the marketplace much sooner than 30 days. Thorough submission, Adrian, you brought that up, and set expectations accordingly. And then Bill, from your standpoint, think differently, right? Don't think about it all packaged up together. We may need to bifurcate a couple things there. Hey, Bill, while you're off mute, if I may, I'm going to jump to you now. We had a discussion about a month ago, and you discussed some kind of proactive measures that you're using within the personal lines practice group to get agents to kind of think across their entire portfolio. I think you just hit on it to a certain degree here, to kind of think beyond account by account, but look at it more along the lines of what their portfolio looks like and what the solutions might be. Can you elaborate a little bit more on that topic, please?
Yeah, sure. I think the important thing is we're talking about 2023, but we're thinking about 2028. And so we aren't going to take quick solutions to long-term problems and long-term challenges. So we're going to stand firm in our role as personal insurance professionals and risk managers and consultants to our retail agents. We're going to focus on business that we believe is going to be long-term the most profitable business to write. We're not looking to just write whatever we can at the moment and find the cheapest way to do it. We're really still trying to stay, for our own sake, as well as the sake of our retail partners and our carriers that we work with, we're looking at long-term profitability. And this market is a great time, I think, to shore up your portfolio and make sure that you've got quality business and you want to retain the clients that are going to be here 5 years from now. So that's where we're going to be at, and we're going to focus on customized solutions. We've got a lot of people looking for $50,000, $100,000, $250,000 deductibles on their homes, and so we're talking to our carrier partners about that. We launched a wind deductible buyback product last year, late in the year, because we know that the wind deductibles are going up, and so we think that's a great way to help our agents bring a new solution on the personal side that has been on the commercial side for quite a while. And then we're looking at risk mitigation. How do we help our clients be better insureds for the carriers? And so we're talking about wind mitigation. Our wildfire defense service is still going strong out west, protecting properties out there from wildfire. So we're gonna keep doing what we've always done. This market, I know it can be tempting to take shortcuts, and there's a lot of business out there that could be grabbed that isn't really going to be great business 2-3 years from now. And so we're gonna stand firm, and we're gonna work with our partners, and we're gonna provide them the best solutions we can.
Thanks, Bill. Appreciate that. Interesting. I read this morning in USA Today that evacuations are ordered as California, quote unquote, bomb cyclone unleashes powerful winds, heavy rain, state of emergency declared. So, wow, when we've historically talked about wildfires and all, but now it's something even different, particularly in Northern California. For anyone up there, our thoughts are with you as you go through this, kind of difficult time. Not only a lot of rain, but winds in I saw even 80 miles an hour. So difficult time for our friends out in California there. We're kind of winding down here. A couple more questions. Adrian, I'm going to shift over to you. Something that's been in the press recently, I found it fascinating just because I'm an insurance nerd, and that is litigation financing. Clearly, that's impacting the casualty marketplace, and more specific within the umbrella excess area. Can you share with the audience today what type of an impact that may have? And I guess to be specific, anyone that didn't see I won't mention it by name, but the the weekly program that comes on CBS on Sunday evenings. 2 weeks ago, they had a sector on litigation financing. So, Adrian, how does that impact the umbrella excess marketplace from your perspective?
Yeah, I mean, it really does show you litigation fundings in the mainstream when a certain program that usually lasts about an hour on a Sunday night is shown a 20-minute segment on litigation funding. So it was quite fascinating to see it. Obviously, it's now become private equity's got involved, and it's become an industry, and the returns are obviously going to be a lot higher than the stock market. We have a lot of trends right now, obviously, with inflation getting high. So these private investors are looking to invest their money, and this looks a very lucrative area. 25-30% returns are possible. So it's created a whole new cottage industry now. So this is only going to drive litigation in the system. Right now, I feel litigation has slowed down with COVID. It's going to accelerate again. So I'm sure all our underwriters and a lot of these new facilities out there are going to be managing, their limits very, very carefully and sort of evaluating these awards. But as we read in the press every week, there's a nuclear verdict. Definition of a nuclear verdict is basically a $10 million loss or higher is kind of where it comes in. And, we've heard a lot of talk about the reptilian theory and what the plaintiffs' attorneys have been doing to appear to the jury's inner core values. And there's a book going back to 2009, The Manual of the Plaintiff's Revolution, which I got a copy of it by David Ball and Don Keenan, and that apparently was what triggered all of this back in 2009. It's gone through the legal system, but I really feel some of the things that our carriers can do is build up their claims departments, have a pre-litigation strategy. Insured should be meeting and develop what they should do when they get a large loss happens, particularly in the trucking industry. You need to have a pre-litigation strategy put in place, and then obviously a strategy with your law firm going forward. And I think that's really how the industry needs to approach this. But it's obviously going to get a lot worse looking at what's happened on that recent program. So it's kind of where I'm at on it.
Yeah, hey, interesting. And that pre-litigation strategy, very important. A little plug, we have, claims expertise here within the Burns and Wilcox organization with some great folks that can assist as well. So we're here and ready to help with respect to some of the folks that we have on the team here. Winding down on time here. Barry, I'm going to end with you. Seems like we've talked here about, we've been around all the coastal states, right? We went from California around to Texas, Louisiana, through Florida, up the East Coast. Interestingly, I think, we should talk about the non-coastal states for a moment. What comes to mind is Kansas, Colorado, New England, some of those states there from a property perspective. What should our clients be thinking about with respect to all of those areas? Are they CAT or non-CAT?
Well, it's interesting, as I mentioned before, the non-CAT states, but they actually have convective wind. If you went back prior to these last 6 years, which have been so heavy named storm hurricane focused, every year you have a lot of convective wind that comes through Kansas and Colorado, Missouri, and those areas. So over the past few years, you've seen raised increases in percentage deductibles in all those areas, which 10 years ago did not exist. So the bad part about the treaty reinsurers and the renewals that we've gone through this year and the past year, that affects everybody. And so even if you're not in a CAT exposed state, you're still paying for part of that. And it's all doom and gloom to some degree, but remember, everybody's got the same deck of cards they're playing with. All your competitors have that, all our competitors have that. But the difference is bringing us to the table with you early, having these discussions, trying to educate clients so that they can be prepared to make tough decisions when it comes up to their renewal date.
Yeah, hey, thanks, appreciate that. And yeah, couldn't agree more. I think the convective storms and, I live in the Northeast here, we've seen some hurricanes find their way up here as well. And that's usually not the case. So clearly property is, CAT is almost in every state, if not every state, depending on who you speak with. So I'm showing 215. A sincere thank you to today's panelists. Bill, Barry, Adrian, thank you for your time, your expertise. I enjoy working with you guys. We could probably chat all afternoon if we wanted to. A big thank you to our audience. We had a large group of folks today. If we didn't get to something, please reach out to myself, any of the panelists, your local Burns office. We'd be more than happy to discuss things further and chat with you further. Thank you so much for your business. Thank you so much for your time, and a very happy 2023 to everyone. Take care now.
Thank you.
Thank you.
Thank you.